To the first lesson in the Securities and Investments unit. In this lesson, we'll be covering mutual funds, what they are, what types exist, how they work, and how they can be useful in your financial ventures. First, let's start off with clearly defining what mutual funds are. Mutual funds are a form of investment that pools money from multiple investors and invests in a diverse portfolio of securities such as stocks, bonds, and other assets. The diversification can help spread the risk by investing in different industries, sectors, and asset classes. This reduces the impact of any single investment on the overall portfolio, potentially minimizing losses and increasing the potential for returns. Think of it as a class potluck, where everyone brings different and unique food. A mutual fund is like a potluck but for your money. Instead of investing in a single company or asset, you're all pooling your money together with other investors to buy many different investments. So who runs them? They're managed by professional fund managers or investment teams who have expertise in selecting and managing investments. These managers conduct research, analyze market trends, and make informed decisions on behalf of the investors. Their goal is to generate returns and outperform the market on the long term. Many managers do this at banks such as JP Morgan Chase, Charles Schwab, etc. There are also many firms that do this service. Funds are complex operations, but let's break down some of the details about their functioning and the concept as a whole. Each mutual fund has a specific investment objective that defines its goals and strategies. Common objectives include income generation, capital appreciation, which is the increase in mutual fund price, or a combination of both. Understanding the investment objective of a mutual fund is crucial and important for investors to ensure that it aligns with their investment goals and risk tolerance, that is, how much risk they can deal with. Think of it as a group project where everyone has a clear objective. Likewise, a mutual fund has a specific objective that outlines its goals and strategies. So let's talk about these risks. Mutual funds, like any other investment, involve risks. The risk of a mutual fund depends on its investments. For example, generally investments with higher potential return on investment also come with an increased risk. High risk, high reward. It is important for investors to assess their risk tolerance, considering factors such as their investment goals, time, and financial situation. By understanding the risks associated with a particular mutual fund, investors can make informed decisions and build a diversified portfolio that balances their risk and potential returns. So let's summarize what we just learned. So the definition of a mutual fund is an investment that gathers money from multiple different investors. These investors invest in diverse securities such as stocks, bonds, and other assets. This diversification helps spread the risk across industries, sectors, and asset classes. These mutual funds are managed by professional fund managers or investment teams. Their goal is to generate returns to outperform the market over the long term. However, the individual investors must align their objectives based on their goals and risk tolerance. Mutual funds, of course, involve risk based on their investment. Higher potential returns usually mean increased risk, that is, high risk, high reward. These investors should assess risk tolerance considering goals, time, and their own financial situation. Now, we might have scared you a little bit with all of this risk, but don't worry, there are plenty of advantages to investing in mutual funds that make it certainly an option worth considering for every investor. Just head on over to the next short video for a rundown of the advantages and an explanation on some of the other complexities surrounding mutual funds.